Have you ever, just stared at a chart, completely convinced that a pattern was forming, only to just watch the market do the exact opposite?
Oh, yeah. Every day. It is, it's really the great humbling mechanism of the financial markets.
Right. Like, what if everything you thought you knew about trading was just entirely upside down? What if price isn't actually the cause of market movement, but, just the result?
Most participants spend their entire lives trying to predict the
Yeah.
exhaust pipe,
Yeah.
right? And they completely ignore the engine that's actually driving the vehicle.
Yeah, exactly. Okay, so let's unpack this. Because most of us, we just feel like the market is this random noise.
Totally random. Or rigged. That's the other one you hear.
Right. The market is rigged. And because of that, we overtrade. We get these incredibly inconsistent results. I mean, you ride this emotional roller coaster every single day.
You see the perfect setup, the indicators align, you take the leap, and then bam.
Bam. The price turns around, it stops you out, and you're just left sitting there wondering what you missed. So today, in this deep dive, we are going to fix that.
We really are.
We're taking a look at a massive amount of material institutional trading manuals, macroeconomic white papers, deep quantitative research to completely tear down that traditional bottom-up approach to markets.
Which is, frankly, long overdue.
Definitely. We are moving away from the retail obsession over, entries and signals and indicators, and we are replacing it with a completely different model.
A top-down model. And I really want to be clear right from the start here. This isn't just like another trading strategy to add to your toolkit.
Right. It's not a new RSI trick.
No, no. We are talking about a total paradigm shift in how you actually perceive financial data. It's known as the DeepMarketShift Framework.
And the core philosophy here, it really requires you to unlearn almost everything you've been taught by standard technical analysis.
Exactly. Markets do not move because a geometric pattern randomly appears on a chart.
No.
They do not move because a couple of moving averages finally crossed over on a Tuesday afternoon.
I imagine that's a bitter pill to swallow for someone who just spent, 6 months memorizing candlestick patterns.
Oh, it's brutal. But the market, frankly, doesn't care about your trend line.
It really doesn't.
It genuinely does not even know your trend line exists. Markets move for one reason and one reason only, and that is capital allocation.
Capital allocation.
Massive players. We're talking institutions, central banks, sovereign wealth funds, giant asset managers. They are constantly responding to macroeconomic incentives.
And when they move billions of dollars, price moves. That is the engine.
Right. Price action on a chart is literally just the exhaust left behind by that capital.
That analogy, though, it paints a pretty brutal picture of retail trading. Like,
Yeah.
if you are only looking at the price, you are basically standing in the street breathing in the smoke while the car drives away.
Yeah, but that is the reality for the vast majority of participants. I mean, to get you out of the smoke, we're going to explore a very specific three-part hierarchy today.
The roadmap.
Exactly. It consists of regime, structure, and campaign. And this roadmap, it doesn't just give you a new indicator. It explains how to actually track the flow of real capital.
Which is huge, because once you understand the mechanics of this hierarchy, the whole illusion of the market as a chaotic, unpredictable beast,
Yeah,
it starts to fade away.
it does. And a very logical, incentive-driven machine emerges right in its place.
So before we can build this new framework, though, we really have to deconstruct why the old way is failing you. We have to tear down the trap that, 99% of retail traders fall into.
The bottom-up trap.
Yeah. My hypothesis is that people naturally default to this bottom-up approach, starting with indicators and entries, simply because it's the only thing they feel they can actually control.
Oh, absolutely.
Like, they can't control inflation, so they just ignore it. And they focus on when a red line crosses a blue line on their screen.
You're tapping into a very deep psychological bias there, but it is a massive structural error. Think about the mechanical workflow of a traditional retail trader.
Okay.
They sit down, they open a chart, and they immediately look for a signal to execute. Maybe they're looking for a bullish engulfing candle, or they rely really heavily on an oscillator like the RSI.
Actually, let's define that real quick because people throw RSI around constantly, the relative strength index.
Right, the RSI is simply a momentum oscillator. It basically calculates the magnitude of recent price gains compared to recent price losses over a specific period, usually 14 days or periods.
Okay.
And it spits out a number between 0 and 100. And traders are taught that if it's over 70, the asset is quote-unquote overbought and they should sell.
And if it's under 30, it's oversold and they should buy.
Exactly.
Which, I mean, that sounds logical on the surface. Buy low, sell high, right?
It sounds logical until you realize it completely ignores the surrounding environment. I mean, starting at the very end of the process, which is execution without understanding the broader conditions, is basically financial suicide.
Because it's completely blind.
Right. If a massive macroeconomic force is actively drawing capital out of a specific currency or stock, the RSI can stay oversold for months.
Oh, wow.
It will just keep grinding lower, wiping out every single trader who tries to buy the dip based on a mathematical formula that is, frankly, utterly blind to the underlying capital flow.
It's like trying to plant a seed just because the calendar says it's spring, but completely ignoring the fact that you're standing on solid concrete instead of fertile soil.
That is exactly it. The environment dictates the outcome, not the action itself. When a central bank or like a massive hedge fund decides to move $10 billion, they are not pulling up a 15-minute chart to check the RSI.
No, I wouldn't think so.
They are trading incentives, they are analyzing interest rate differentials, global liquidity conditions, and forward-looking inflation dynamics.
But because retail traders kind of refuse to play that macro game, they retreat into these microscopic details, which leads to like the ultimate distraction.
Time frame.
The time frame debate. I mean, you see this constantly on forums and social media. People asking, should I trade the 5-minute chart, the 15-minute? Is the 1 hour better for finding the trend?
It's treated like a religious debate.
It really is.
But the irony is that time frames are largely irrelevant to the actual mechanical movement of the market. I mean, the market does not move because a 15-minute candle officially closed.
Right.
The ticking of a clock and the closing of that arbitrary window of time means absolutely nothing to the underlying mechanics of institutional supply and demand.
Because the capital is moving anyway.
Exactly. Capital enters, exits, or reallocates, regardless of where your specific candle decided to print its closing price.
Let's zoom out for a second. Trying to predict market direction by only looking at price indicators on a specific time frame, it's like trying to predict the weather by watching a single leaf blow in the wind.
That's a great way to put it.
Right. You're staring so hard at the leaf, completely ignoring the massive atmospheric pressure system right above you. You might guess right for a few seconds based on a gust of wind, but when the hurricane arrives, the leaf's previous direction isn't going to save you.
Not at all.
But, I mean, if time frames are genuinely irrelevant to capital flow, why is the entire industry so obsessed with them?
It comes back to the illusion of speed, right?
Mm.
And the dopamine loop. Humans are wired to seek immediate feedback.
We want to feel like we're doing something.
Precisely.
Right.
When you look at a 1-minute or a 5-minute chart, you get a hit of dopamine every few seconds. Things are flashing red and green, numbers are moving quickly, and it validates your existence as a trader.
Yeah, you feel busy.
You feel like you are actively participating. But time frames are just different mathematical lenses on a camera. They are not different realities.
You're just zooming in on the exact same data set.
Precisely the same data. If you take a magnifying glass to a massive oil painting, you will see the individual brushstrokes and, the texture of the canvas, but you completely lose the image of the landscape.
You miss the forest for the trees.
Right. Obsessing over the micro time frames blinds you to the macro forces. It blinds you to that atmospheric pressure system you just mentioned.
Which brings us to the very first and honestly most important pillar of the DeepMarketShift Framework.
Layer 1, the regime.
The regime. This is a foundation everything else is built on.
Yeah, the regime is the invisible gravity of the market. It is the dominant macroeconomic environment that dictates the absolute direction of capital pressure.
Notice you use the word pressure there.
Right, because it doesn't mean price moves in a straight line every single second, but it means there's a relentless underlying current pulling capital in a specific direction over the long term.
Now, when we say macro environment, we need to be very careful because a lot of people hear macro and immediately think of like the 24-hour financial news cycle.
Oh yeah, the talking heads.
Exactly. They think of whatever people are shouting about today, or maybe a controversial tweet from a CEO or some minor political scandal.
Those things are just noise. They are the complete antithesis of regime. Regime is about deeply rooted financial incentives. It is the structural plumbing of the global economy.
So it's not a news chyron.
No, it's driven by massive, slow-moving forces that do not change based on a headline.
So let's break those forces down. What actually creates this invisible gravity?
There are 4 primary drivers that dictate a regime. You have Monetary policy, inflation dynamics, growth expectations, and global liquidity.
Okay.
These are the gravitational forces that force massive institutions to literally reallocate their capital.
Mm.
Let's look closely at monetary policy, specifically interest rates, because it's often the most powerful.
Yeah, walk us through the mechanics of that, because I think people hear interest rates and their eyes glaze over. How does a central bank tweaking a percentage point actually force the market to move?
To understand this, you have to remember two things about capital. It is inherently lazy, but it's also aggressively greedy.
Lazy and greedy. I like that.
It constantly seeks the highest possible return for the lowest possible risk. So, when a central bank, like the Federal Reserve, starts raising interest rates to combat inflation, they are fundamentally changing the risk-free real return.
Right.
The yield on government bonds, which are considered virtually risk-free, begins to rise.
So suddenly, an institution doesn't have to take wild gambles in the stock market just to hit their return target.
Exactly. Imagine you are managing a sovereign wealth fund with $100 billion.
Okay.
Your mandate is to grow that wealth safely. If interest rates are near zero, as they were for years, you're basically forced to buy riskier assets, tech stocks, venture capital, high-yield junk bonds, just to generate any kind of return.
Because bonds pay nothing.
Right. But when the central bank raises rates to, say, 5%, the math completely changes. Suddenly, you can get a guaranteed 5% return just by holding government debt.
So the lazy capital wakes up and realizes there's an easier way to make money.
And it moves violently. Capital gets sucked out of those riskier, highly speculative assets, and it flows into the safety of high yield.
Wow.
This isn't a theory, and it isn't based on an indicator on a chart. It is a mechanical necessity. Fiduciary duty actually requires these fund managers to adjust their portfolios to the new risk-reward reality.
Because they'd be legally negligent if they didn't.
Exactly. And that reallocation of trillions of dollars creates a relentless, persistent pressure on prices across the board. That is a regime.
That makes perfect sense. So we can actually categorize these different environments. Based on the institutional manuals we're looking at, what are the main types of regimes we need to be identifying?
You can break them down into a few primary dichotomies. The most common is the risk-on versus risk-off regime.
Okay, risk on.
In a risk-on regime, growth expectations are high, corporate earnings are expanding, and central banks are usually keeping liquidity really abundant.
So money is cheap.
Money is cheap. Capital is actively seeking growth and is willing to absorb a lot of volatility and risk to get it. Markets tend to trend higher aggressively.
And risk off.
In a risk-off regime, the priority flips entirely to capital preservation. Fear enters the institutional landscape, growth slows down, and money just floods into safe havens,
Like what?
like the US dollar, gold, or treasury bonds.
Okay, what about the inflation side of the equation? Because we've certainly seen how that changes things over the last few years.
Exactly. You have inflationary versus disinflationary regimes. And this dichotomy heavily dictates asset class performance.
How so?
Well, in a deeply inflationary environment where the actual purchasing power of fiat currency is just eroding month by month, holding cash or fixed income bonds is a guaranteed loss in real terms.
Because your money buys less.
Right. So capital naturally flows toward tangible, real assets. You see massive bull markets in commodities, oil, copper, agricultural products, and real estate.
Which we've definitely seen.
Conversely, in a disinflationary regime where price increases are cooling and growth is stable, financial assets like technology equities and long-duration bonds tend to dominate.
Because the future value of their cash flows isn't being destroyed by inflation.
Precisely.
This also bleeds heavily into the foreign exchange markets, right? I want to touch on currencies because the framework mentions carry regimes, which sounds a bit technical.
It is, but the Forex market is purely driven by these macro differentials. We look at carry-friendly versus carry-unfriendly regimes.
What does carry actually mean here?
Carry is a very specific institutional strategy. It basically involves borrowing money in a currency that has a very low interest rate and using that borrowed money to buy assets in a currency that has a high interest rate.
So you're just pocketing the difference.
Exactly. You are essentially pocketing the yield differential.
The classic example being the Japanese yen carry trade, right?
A perfect example. I mean, for decades, the Bank of Japan kept interest rates at or near zero. So massive hedge funds would borrow Japanese yen at almost zero cost, convert that yen into US dollars, and buy US Treasury bonds yielding 4 or 5%.
Wow.
And as long as the exchange rate stays relatively stable, it is basically free money. That is a carry-friendly regime. Low volatility and clear yield differentials drive massive, persistent capital flows out of Japan and into the U.S.
But what happens when things get unstable? Because free money doesn't usually last forever.
No, it doesn't. It becomes carry-on friendly. If volatility suddenly spikes, perhaps the Bank of Japan unexpectedly intervenes, or global panic causes the yen to surge in value, the math falls apart.
Oh, because the currency moved.
Right.
Yeah.
The risk of the currency fluctuating wipes out the benefit of the small yield differential. Suddenly, these massive funds have to unwind their positions all at once.
Which means they have to sell everything.
They have to sell their U.S. assets, buy back the yen to repay their loans, and it causes violent cascading market moves.
And the most vital takeaway for you, the listener here, is that these regimes, whether it's risk-on, inflationary, or carry-friendly, they do not flip back and forth every Tuesday.
They are incredibly persistent. Policy does not change overnight. The Federal Reserve does not raise rates by 50 basis points on a Wednesday and then cut them by 50 on a Thursday.
That would be insane.
A tightening cycle takes months, sometimes years, to play out. The structural pull of an interest rate differential or an inflation trend exists whether the financial media is talking about it on a given day or not.
It just hums away in the background.
Constantly exerting pressure.
This is exactly why retail traders who try to counter-trend trade get absolutely slaughtered. I mean, if the macro gravity is actively pulling capital out of speculative tech stocks because interest rates are rising and you are constantly trying to buy the dip on a 5-minute chart.
Because your RSI oscillator says it's oversold.
Right. You aren't being a contrarian genius there. You are literally standing in front of a freight train of institutional capital reallocation.
You are fighting math, and math always wins in the long run.
Okay, I do have to push back on this idea of persistence, though, because if regimes are these massive, slow-moving, multi-month trends, why do we see so many sudden, violent market panics?
Sure.
Think about the days where the S&P 500 just drops 3% out of nowhere, or currency pair flash crashes. If the macro gravity is so stable, what causes the sudden turbulence?
It's a good question.
How does someone distinguish a real fundamental regime shift from just a scary headline causing a temporary freakout?
You are conflating a liquidation event with a regime shift. It would look similar on a short-term price chart, but mechanically they are completely different.
Explain that difference.
Short-term news, a geopolitical flare-up, a missed earnings report, creates immediate emotional reactions. Human beings panic, and more importantly, algorithmic trading systems get triggered.
Right.
When price drops quickly, it hits the stop-loss orders of over-leveraged traders. Those stop losses trigger automatic sell orders, which pushes the price down further, triggering more stop losses.
A domino effect.
It is a cascade of forced selling. That is a liquidation event.
So the market is really just clearing out the weak hands and the excessive leverage.
Precisely. But, and this is the absolute key to layer one, unless the underlying macro incentives have fundamentally changed, the regime remains entirely intact.
Because a headline doesn't change reality.
The scary headline did not change the central bank's interest rate. It did not fix supply chain inflation. It did not alter the yield differential between two countries.
So the noise passes, the gravity remains.
Exactly. The headline might cause a brutal two-day sell-off, but if the macro incentives are still drawing capital into that asset class, the institutional buyers will eventually step back in at those discounted prices.
And the trend resumes.
And the underlying trend will resume. Understanding this protects you from getting shaken out of valid positions by temporary panic.
You stop reacting to the leaf blowing around, and you trust the atmospheric pressure.
Beautifully said.
Which perfectly leads us into the next layer of the framework. Because knowing the invisible gravity exists is vital, but we need a practical way to actually see it working on our screens.
Exactly.
Now here's where it gets interesting. We move to layer 2. Structure. If the regime is the invisible gravity of the market, structure is how we actually see that gravity pulling on the physical world.
You can't see atmospheric pressure with the naked eye, right? But you can look out the window and see the trees bending. You can see the storm surge.
Right.
Structure is the footprint of capital. It is the explicit, measurable path that capital takes as it moves through the market. It is how macro pressure expresses itself in price action over time.
So we're finally looking at the chart. We're looking at the actual shape of the market. According to the deep dive materials, what does structure actually look like? What are the core forms it takes?
It generally takes 3 distinct forms. First, you have trends.
Trends, okay.
This is the most obvious and recognizable structure. It is persistent directional movement. It means the macro gravity is so strong that capital is flowing heavily in one direction absorbing any opposing sell orders,
And driving price higher or lower in a sustained way.
like a staircase pattern. Higher highs and higher lows in an uptrend, lower highs and lower lows in a downtrend.
Right, that's the classic definition everyone learns on day one. What's the second form?
The second form is ranges. This is where capital is rotating.
Rotating, what does that mean?
The macro forces might be in a temporary state of equilibrium, or major participants are waiting for new data. Buyers and sellers are basically balanced, and price bounces between established boundaries. It just looks sideways.
Okay, and the third?
And the third form is transitions. These are the messy, chaotic shifts from one structural condition to another.
Like a trend ending.
Exactly. It's the moment a trend exhausts itself and breaks down into a range, or the explosive moment a range breaks out into a new trend.
Now, when retail traders hear about trends, ranges, and transitions, they immediately start trying to apply the hundreds of chart patterns they've memorized.
Absolutely.
Double tops, cup and handles, ascending triangles, flags, pennants. There is an entire cottage industry dedicated to just naming these shapes.
And the DeepMarketShift Framework strongly urges you to throw those rigid labels
Right.
right in the trash.
Wait, really? Throw them away.
Entirely.
Yeah.
Identifying behavior is vastly more important than slapping a label on a shape.
Why is that, though? Why are the labels so dangerous? I mean, a head and shoulders pattern is famous for a reason, isn't it?
Because a label is just a static name applied to a highly dynamic, fluid process. It creates rigidity in your thinking.
Okay.
If you are desperately looking for a perfect textbook head and shoulders pattern, your brain will try to force the data to fit your preconceived bias. You might entirely miss what the actual capital is doing beneath the surface.
So instead of memorizing names, you need to observe the behavior of the participants. Give me an example of observing behavior versus looking for a label. How does that look in practice?
Let's say price is approaching a previous high. Instead of asking, is this forming a double top pattern? You should ask behavioral questions.
Like what?
As price moves up, is volatility expanding or compressing? When price hits that historical level of resistance, are the sellers defending it with massive volume? Or are the buyers easily absorbing the selling pressure?
Are they forming higher lows right underneath it, basically?
Exactly. Are large orders slicing right through liquidity zones, or are they being halted?
It really is the difference between memorizing a script for a play and actually listening to a dynamic conversation and reacting to what the other person is saying.
It is a profound shift in awareness. And when you start listening to behavior rather than looking for shapes, you uncover one of the biggest illusions in the entire trading world.
Which is?
The illusion of chop.
Oh man, chop, the dreaded sideways, messy market. This is where accounts go to die. Every retail trader I know absolutely despises chop.
They despise it because they don't understand the mechanics of what is actually happening. We need to dive deep into institutional accumulation and distribution.
Let's do it.
This is the secret language of the market. Remember our earlier example of the $100 billion sovereign wealth fund?
Yes, the big players.
Let's say their macro analysis tells them a new inflationary regime is starting, and they need to buy $2 billion worth of copper futures.
Okay, $2 billion? They can't just log into an app and hit buy market for $2 billion.
If they did, it would be a disaster. The order is so massive, it would eat through every single sell order on the books.
It would spike the price instantly.
It would instantly spike the price of copper by 20%, and they would end up paying a massive premium for the bulk of their position. They would ruin their own average entry price through slippage.
So large players cannot enter the market all at once.
It is mechanically impossible.
So how do they actually deploy that kind of capital? If they can't just click buy, what do?
They have to build their positions quietly, over weeks or even months. They use VWAP algorithms, volume-weighted average price, to slowly drip their orders into the market.
Okay.
But more importantly, they have to absorb the opposing flows. If they want to buy $2 billion worth of copper, they literally need other people to sell them $2 billion worth of copper.
So they need the market to look unappealing to everyone else.
Exactly. They keep the price contained within a specific range and accumulation box. Every time the price dips toward the bottom of the range, they step in and buy aggressively, supporting the floor.
But when the price rallies toward the top,
They stop buying. They let the short-term speculators and day traders take profits and push the price back down.
that's sneaky.
They are constantly accumulating, but they are carefully managing the price action to prevent a breakout before they have filled their massive order.
That completely flips the script. So what looks like a boring, choppy, untradeable mess with no opportunity to a retail trader looking at a 15-minute chart.
is actually the most important phase of the entire market cycle. It is the critical groundwork being laid for a massive future movement. The chop is the sound of institutional capital quietly loading the spring.
Wow.
If you don't understand structure and behavior, you get frustrated by the chop. You try to trade the random noise inside the box, you get chopped up, you hit your stop losses, and you lose your capital.
Because like you're trying to find a trend where there isn't one.
But if you understand accumulation, your perspective shifts entirely. You sit patiently, you watch the footprints being formed.
You notice that the dips are getting shallower, meaning the institutions are having to pay slightly higher prices to get their fills.
Exactly. And you prepare for the expansion.
This circles right back to the illusion of time frames, doesn't it? The fractal nature of markets.
It does. Structure is completely fractal. That messy, chaotic, choppy accumulation phase might look like absolute untradeable noise on a 5-minute chart.
It looks like a heartbeat monitor going haywire.
But if you zoom out and look at the exact same data on a daily chart, it might be a perfectly clean, beautiful structural consolidation sitting right above a major historical support level.
The structure is identical, the lens you are viewing it through is just different. If you are getting chopped up, the solution usually isn't a new indicator, it's usually just zooming out.
Precisely. You have to find the time frame where the structure is clear, not the time frame that gives you the most dopamine hits.
Okay, I want to challenge this concept with an analogy, though. I get it, structure is like footprints in the snow. I can look at the ground and see that a giant institutional bear walked through here.
Okay.
But if I see heavy footprints, meaning I identify that accumulation is clearly happening in a choppy market, isn't it incredibly dangerous to jump in too early?
In what sense?
Well, I see the footprints, but the bear might just be taking a nap for another 3 months. If I buy into the accumulation phase before the trend is completely obvious, aren't I just trapping my capital in dead money?
That's a fair point.
Or worse, what if I misread the footprints and it's actually distribution? How do we actually participate without getting completely chopped to pieces while we wait for the real move to start?
You're hitting on the exact reason why retail traders fail, even when they get the analysis right. Your concern is totally valid, but it stems from a flawed premise.
How so?
You are assuming the goal is to jump in and perfectly time the breakout. You are still applying traditional isolated trading logic to a macro framework.
Oh, I see.
If you go all in, right in the middle of a choppy range because you suspect accumulation, you are recklessly exposing yourself to volatility. You will likely get stopped out by a random newswick before the real macro move even happens.
So how do you solve that?
To solve this, you cannot use traditional execution tactics. You need an entirely different philosophy for how you deploy capital.
Which brings us to the final piece of the puzzle. We have layer 1, the regime, layer 2, the structure, and now layer 3.
The camp.
But the real story is, knowing the weather, the regime, and seeing the footprints in the snow, the structure is completely useless unless you know how to safely navigate the terrain yourself.
Right.
You need a vehicle. That is the campaign, the art of participation.
Notice you said participation, not trading. We need to draw a very hard line between trade logic and campaign logic. They are functionally opposite mindsets.
Let's break that down. I imagine most retail guys are operating in a very binary way. They see a setup, put a tight stop loss on it, and it's basically a coin flip. They are treating it like an isolated casino bet. Is that what you mean by trade logic?
That is the exact definition of trade logic. It treats every single entry and exit as an isolated, independent, discrete event.
Okay.
You open your software, you see a signal, you calculate a specific risk-to-reward ratio, you put your stop loss at a very specific tick on the chart, you set your take profit at another specific tick, and you pull the trigger.
Very rigid.
From that moment on, you are in a binary state. You win the bet or you lose the bet. And once it's over, you move on to the next entirely disconnected event.
It's a highly rigid way of operating. You are either perfectly right or you are wrong. And the market has to do exactly what you want in the exact time frame you want it, or you lose money.
And that rigidity creates massive, unsustainable psychological pressure. It demands perfection in timing, which we know is impossible to achieve consistently.
Right. So what is campaign logic then?
Campaign logic, which is drawn from institutional portfolio management, views the market entirely differently. It views market participation as a continuous, dynamic process.
Continuous.
You don't just take a trade. You build, manage, and adjust a position over time in response to the structure. You are managing a campaign.
So how does a campaign actually initiate? I'm assuming we need the first 2 layers to give us the green light.
The golden rule of the framework is alignment. A campaign only begins when structure aligns with regime.
Okay, alignment is key.
The macro incentives, the invisible gravity we discussed in Layer 1, must be actively pulling in the same direction that the price structure in Layer 2 is currently moving.
And when you have that,
When you have that alignment, your edge is so massive that you no longer need perfect timing. You don't need to catch the absolute bottom tick of the chart. Your focus shifts to entering the market when conditions broadly support your bias.
but mechanically, how do we enter if we aren't just going all in on a breakout signal and crossing our fingers?
You utilize scaling, building a position in tranches. This is the superpower of the campaign approach.
Let's walk through a scenario.
All right, let's say you identify that the regime is heavily bullish. Perhaps inflation is rising and capital is flooding into commodities.
Okay.
You look at the structure of crude oil, and it is showing clear signs of accumulation. It's ranging, but making slightly higher lows.
So the macro and the structure are aligned.
Exactly. But you do not dump your entire account balance into oil futures on a Tuesday morning. You initiate a small pilot position. You put your toe in the water.
You're testing your thesis with real capital, but you aren't risking the farm if your timing is a bit off.
Exactly. You might deploy only 10 or 20% of your intended total risk. Now, you wait.
You wait for confirmation.
As the structure continues to unfold and confirm the regime as price finally breaks out of the accumulation box and starts making higher highs, establishing a formal trend, you increase your size.
Ah.
You add your second tranche, you add a third tranche on the first structural pullback, you scale into the position as the market actually proves your underlying thesis correct.
That shifts the entire psychological burden. You aren't stressed about being perfectly right on the first try, because if you're wrong early on, the position is tiny.
Exactly.
You take a paper cut and move on. If you are right, you scale up aggressively and capture the bulk of the macro move.
It completely eliminates the need for precision. If you are slightly early and the market chops around for another month, your position is small, so the sheet you take is minimal. You can easily survive the chop.
But what about when things aggressively go against you? Because even in a strong macro regime, markets don't move in straight lines.
They never do.
Yeah.
Meaningful pullbacks are mathematically guaranteed. Market makers have to rebalance, short-term participants take profits, algorithmic models adjust.
Right.
And this is where managing a campaign requires a deep tolerance for noise. Because retail traders operate on trade logic, the moment a normal 5% pullback happens, their isolated trade goes into the red.
And panic sets in?
Panic. Their rigid stop loss gets hit, or they manually exit out of fear. They take a small loss.
Yeah.
Then a week later, the market absorbs the selling pressure, resumes its macro trend, and goes exactly where they originally thought it would. But they are sitting on the sidelines in cash.
The ultimate frustration. Getting violently shaken out of a perfectly valid thesis just because of a short-term pullback?
Exiting prematurely due to short-term fluctuations destroys your edge in this framework. A campaign requires you to hold through that structural noise.
Because you aren't guessing anymore.
You know that the massive macro incentives like interest rates and liquidity, are still actively pushing capital in your direction. A temporary pullback on a daily chart does not negate the invisible gravity of a multi-trillion-dollar liquidity cycle.
I see how powerful that is. But wait, we need an exit strategy. A campaign can't just be permanent. We aren't just buying and holding forever and ignoring all risk management. How do we know when the campaign is over?
You reduce exposure or kill the campaign entirely only when the underlying layers fundamentally change. It's an objective decision, not an emotional one.
Let's go through the scenarios for that.
Scenario 1. The regime weakens. Let's say you are long technology stocks because of an accommodative central bank, but suddenly inflation spikes and the Fed unexpectedly pivots, signaling aggressive rate hikes.
Okay.
The macro wind is no longer at your back. The gravity is shifted. You immediately cut the campaign, regardless of what the chart looks like.
What's the second scenario?
Scenario 2. The macro data remains fine, but the structure completely breaks down. A major historical support level is violated on massive volume, and the asset starts forming lower lows.
What does that mean fundamentally?
This means that despite what the economic data says, large capital is voting with its wallet to exit the asset. The structure proves your thesis wrong. You exit.
So you don't stubbornly hold on.
The goal of a campaign isn't to stubbornly prove that your prediction from a month ago was right. The goal is to stay continuously aligned with the flow of capital. The moment the capital clearly changes direction at the structural or macro level, your campaign ends.
Okay, I have to play devil's advocate here
Yeah.
because this is where people get into trouble. Managing a campaign, holding through pullbacks, trusting the macro thesis over short-term price action. To a lot of listeners, this sounds dangerously close to just stubbornly holding on to a losing position.
I hear that a lot.
We see this toxic behavior all the time on social media. Diamond hands, right? Never sell, the fundamentals are good, the hedgies are manipulating it. How does a listener genuinely know the difference between intelligently managing a valid campaign through noise and just being in deep psychological denial about a terrible trade?
That is a phenomenal question, and it highlights the most dangerous trap in the entire framework.
Yeah.
It requires brutal, objective honesty to navigate. But if you follow the layers, the distinction between conviction and denial is actually razor sharp.
Okay, break it down.
Denial is holding a position when the structure has fundamentally broken or the regime has officially shifted.
Give me an example.
If the central bank raises rates, crushing the liquidity for your speculative asset, and the price slices through a major structural floor, but you continue to hold on because you believe in the project's technology,
Yeah.
that is pure denial. That is gambling driven by ego.
You're clinging to the leaf while the hurricane physically blows you off a cliff.
Exactly. You are ignoring reality. A campaign, on the other hand, is holding through market noise because the higher layer incentives are still entirely measurably intact.
So it's data-driven.
You are holding through a 10% price pullback because you've checked the data. The interest rate differential is still massive, global liquidity is still abundant, and the higher time frame weekly structure is still intact and making higher lows.
Your conviction isn't based on emotion or tribalism or diamond hands.
No, it is based on objective, higher layer data that you can point to on a dashboard.
It's conviction backed by institutional evidence, not just hope.
Hope is the most expensive word in the dictionary of finance. A campaign relies on data-driven alignment. It never, ever relies on hope.
Okay, we have the 3 layers fully built out. We understand regime, the macro gravity. We understand structure, the behavioral footprints in the market. And we understand campaign, how we actually scale in, participate, and manage the noise. But knowing the theory in a vacuum is one thing. How does a listener actually apply this on a random Tuesday morning? Let's take all this theory and discuss the actual workflow.
The workflow is where the theory becomes practical, daily application. And it begins by mastering the danger of misalignment.
Because things are rarely perfect?
Exactly. Because you are constantly analyzing these 3 layers independently, you are going to encounter different combinations of signals. You will rarely find perfect conditions. Understanding how to handle misalignment is what separates professionals from amateurs.
Let's run through a hypothetical case study to make this concrete. Let's imagine a guy, we'll call him the breakout buyer. He loves buying when a chart looks explosive.
A very common archetype.
What happens to him when he has a beautifully clear structure, a perfect breakout of a multi-month range looking amazing on the daily chart, but he's operating in a weak or directly opposing regime? The macro data says capital should be fleeing, but the chart is pumping.
Our breakout buyer is stepping into a highly toxic, high-risk environment. That scenario is the equivalent of seeing a massive wave forming, but knowing the ocean tide is rapidly going out.
So it's deceptive.
You might get a short-term violent move upward, but it lacks the deep institutional backing required to sustain a massive multi-month trend. That beautiful breakout is highly likely to be a bull trap.
Why does it happen then if the macro doesn't support it?
Usually it's driven by local speculation, short covering, or algorithmic games, rather than real long-term capital allocation.
It's not real money moving.
Right. If you deploy a campaign into that misalignment, you have to realize the macro gravity is actively working against you. The moment the speculative buying dries up, the underlying regime will reassert itself and the price will collapse back into the range.
Okay, let's flip the scenario. What if our guy has a really strong regime, but a weak structure? The macro data inflation, yield curves, liquidity is screaming that the asset should be going to the moon. The invisible gravity is pulling hard. But he looks at the chart and it looks awful. It's trending down, or it's a choppy, broken mess.
This scenario requires immense monk-like patience. If you have a strong regime but weak structure, it means the ocean tide is fully in, but the wind hasn't created any waves yet.
Okay.
The underlying macro pressure is present, but for whatever reason, perhaps large players are still slowly accumulating, or they're waiting for a specific geopolitical event to clear capital. has not yet decided to express itself in directional price action.
So what if he tries to force a campaign here just because the macro is good?
He will suffer death by 1,000 paper cuts. He will sit in dead money for weeks, tying up his capital. Or worse, he'll get chopped up as the market meanders aimlessly.
Because his timing is completely off.
He has the right idea,
Mm.
but the wrong timing vehicle. He has to wait for the structural footprints to confirm that the macro regime is finally waking up the capital.
And what if he just ignores the layers entirely and enters based on a random indicator signal? No alignment at all.
He is generating random gambling outcomes. He is flipping a coin in a casino where the house takes a cut of every flip.
So alignment is everything.
True, sustainable consistency only arrives when regime and structure are aligned, and your campaign is deployed directly into that alignment.
As you describe this, it sounds like these layers aren't just a checklist. They are constantly communicating with each other. They interact.
They absolutely do. There are vital, complex feedback loops between them. They aren't isolated silos. For example, structure can act as an incredibly powerful early warning system for a regime shift.
Wait, how does that work mechanically? How can a price chart predict complex macroeconomic data before it's even published?
It doesn't predict the data itself. It predicts the institutional reaction to the data.
Okay, give me a scenario.
Imagine you are operating in a strong, bullish macro regime. The central bank is printing money, things are great. But over several weeks, you notice the structure of the leading equities is quietly weakening.
So price is struggling to make higher highs.
Right. Rallies are getting sold off aggressively on high volume. Heavy institutional distribution is happening.
So the chart is showing weakness, but the news is still telling everyone everything is fine.
Exactly. That structural weakness is screaming at you that despite the supposedly positive macro incentives, massive capital is secretly heading for the exits.
I know something we don't.
Institutions have access to alternative data, real-time supply chain metrics, and armies of analysts. They know the macro data is going to turn negative long before the official government report is released next month.
So the structure leads the news.
The structure is telling you the regime is secretly shifting beneath the surface.
Institutional money always moves first. And they cannot hide their massive structural footprints when they do.
They leave tracks in the snow. Conversely, large campaigns, when massive funds all align their thesis and begin deploying billions of dollars simultaneously, can actually accelerate structural momentum.
Because of the sheer size of the orders.
Right. The sheer size of the execution becomes a self-fulfilling prophecy, driving the structural trend harder and faster, which in turn attracts more momentum following capital.
So practically speaking, for you, the listener who wants to implement this framework tomorrow, what does your actual routine look like? What are you doing on a daily versus a weekly basis?
The routine completely changes. It shifts from frenetic, anxious activity to calm, calculated observation.
That sounds nice, honestly.
It is. On a daily basis, your job is absolutely not to find a trade. You shouldn't be scouring 5-minute charts looking for action. Your daily job is simply to track the environment.
So what are you tracking?
You monitor the key policy signals. You check the interest rate markets and bond yields. You map out the structure of your core assets, drawing out the major historical levels of accumulation or distribution, noting any shifts in volatility dynamics.
And what about your open positions?
You review your currently active campaigns and adjust your trailing stops or scale into your tranches if the structure dictates it.
And what if they do that daily review and nothing has fundamentally changed? The regime is stable, the structure is slowly trending, the campaign is fine.
Then you close your laptop and you do nothing.
Nothing at all.
In the DeepMarketShift Framework, often the most profitable, highly skilled daily decision you can possibly make is to do absolutely nothing. You let the macro capital flows do the heavy lifting for you.
That is so profoundly hard for people. Staring at a screen full of flashing numbers and actively choosing to do nothing feels like you aren't working.
It is the ultimate test of psychological discipline. You have to realize that waiting is a position.
Waiting is a position. That's good.
Then, on a weekly or monthly basis, you step back for deep reflection. You zoom all the way out. You ask yourself the hard questions.
Like what?
Is my original regime thesis still fundamentally valid based on the new economic data? Has the higher time frame structure changed its underlying character from accumulation to distribution?
Are my current campaign positions still logically aligned with my original macro thesis?
Exactly. It is a continuous objective reassessment that keeps you grounded in reality rather than emotion.
This entire approach requires an incredible amount of patience and perspective. Let me try an analogy here to tie it all together for you.
Sure, go ahead.
It's like big wave surfing. The regime is the ocean tide. It's this massive, invisible planetary force pulling millions of gallons of water in or out. You can't fight the tide.
Right.
The structure is the wave itself. It's how the water is physically expressing that tidal energy right now, crashing against the reef.
Spot on.
And the campaign is you, the surfer, riding the board, adjusting your weight, deciding when to paddle hard and when to pull back. If the tide is completely out, if the regime is hostile, you don't paddle out and sit in the dry sand trying to catch a wave, no matter how shiny and expensive your surfboard is.
That is a phenomenal way to visualize the hierarchy. You wait for the tide, you monitor the formation of the wave, and only then do you commit to the ride.
It brings so much clarity.
The immense, life-changing advantage of this entire workflow is exactly that. Clarity. It filters out an unbelievable amount of low-quality, toxic market noise.
And it cures overtrading.
It cures it permanently because it forces you to sit on your hands and wait for high-probability alignment. You stop trying to surf on dry sand.
But as we bring this deep dive in for a landing, we have to be realistic with you, the audience. We have to discuss the hard truths about adopting this model. It sounds elegant, but I imagine it's not a walk in the park.
It is absolutely not. We cannot paint this as a magic bullet that will make you a millionaire overnight. The DeepMarketShift Framework is a profound, institutional-grade shift in perspective, but it has strict limitations and requires genuine, sustained intellectual effort.
What's the biggest initial hurdle for someone trying to transition from retail chart reading to this macro framework?
The required knowledge base. This framework demands a genuine, working understanding of macroeconomic dynamics. You have to spend time learning the plumbing of the financial system.
It's not just drawing lines anymore.
No. You need to understand how central banks operate through open market operations, how inflation impacts real yields, how bond markets dictate global capital flows.
Which sounds intimidating.
It can be. You can't just memorize 3 candlestick patterns on a weekend and call it a day. It takes time, serious study, and a willingness to read dense material.
It's an investment in real financial literacy, not just superficial chart reading. What about limitations on the execution side? Who does this not work for?
This framework is totally useless for ultra-short-term scalping.
Really, totally useless.
Entirely. If your personality type dictates that you want to hold a position for 12 seconds and capture 3 ticks of movement on a 1-minute chart, this model is not for you.
Because the macro doesn't matter in 12 seconds.
Exactly. In that microscopic time frame, macro regime means nothing. In a 12-second window, algorithmic order flow, high-frequency trading bots sniffing out liquidity and front-running orders completely dominates the price action.
Macro gravity takes weeks to manifest. Algorithms take milliseconds. And what happens if our surfer gets the macro part wrong? What if they just completely misinterpret the regime?
That is the fatal flaw of any top-down model, because everything cascades down from layer 1. If you misread the regime, if you confidently deduce that the environment is deeply risk-on when the data is actually signaling a stealth shift to risk-off, the entire framework will confidently lead you right off a cliff. Your structure analysis will be biased because you'll be looking for accumulation when distribution is actually happening. Your campaigns will be scaled in the exact wrong direction, and you will lose money systematically, convinced you are right the whole time.
So absolute discipline to the objective data is everything.
Discipline is non-negotiable. Skipping steps ruins the entire process. If you feel FOMO, fear of missing out because a stock is pumping on social media, and you jump into a trade based on a 5-minute chart without doing your regime analysis first, you have completely abandoned the framework.
You are back to being a gambler in a casino.
Exactly.
But if you can maintain that discipline, if you can put in the hours of study to truly understand the macro environment and learn to read the structural footprints, the shift in your consistency, and frankly, the reduction in your daily stress levels is life-changing.
It truly is.
Yeah.
Because it removes the terrible burden of having to constantly predict the immediate future. You no longer have to guess what the next candle is going to do.
As we wrap this up, let's leave you with a final forward-looking perspective, because mastering this framework completely changes how you view a screen with numbers on it. You have to constantly drill this into your mind. You are not trading price.
You are participating in the movement of capital.
Price is just the exhaust. You are tracking the engine. But here's something new to think about as you go to apply this. We've talked about how regimes are slow-moving, multi-month or multi-year forces.
Yes.
But we are entering an era where artificial intelligence and machine learning models are being deployed by these massive institutions to analyze macroeconomic data in real time.
That is the frontier. These AI models can instantly parse a central bank speech, analyze global shipping data, and adjust their inflation expectations in milliseconds.
Exactly. So I want you to ponder this. As AI becomes fully integrated into institutional capital allocation, how might that compress the time frames of these macro regimes? Will a structural shift that used to take 6 months to play out suddenly happen in 6 weeks?
The gravity won't change, but the speed at which capital reacts to the gravity might become exponential.
It's a fascinating evolution to prepare for. The tools change, but the core mechanism, capital seeking the best environment, never will.
Never.
Think about your own decisions in the markets, in your business, or even in your career. Are you just reacting to the immediate chaotic price action right in front of your face? Or are you stepping back, identifying the invisible gravity, and positioning yourself for the massive shift in capital that's coming next?
That's the question you have to ask.
Imagine what happens when you finally stop trying to fight the market, stop trying to guess the next 5-minute candle, and start flowing with its deepest, most powerful currents. That's the deep market shift. Thanks for joining us on this deep dive. Keep watching those currents.